What's up, traders? Anthony Crudele here, and welcome to the Futures Radio Show podcast. In today's episode, we're joined by my man Pharm, a seasoned discretionary trader with a focus on indexes and volume profile. Today, we're diving into a crucial topic: how and when to short a bull market without jeopardizing your account. We'll discuss how to spot early signs of weakness, confirmation signals, and how to identify a short-term opportunity versus a multi-day pullback. Pharm will walk us through his go-to setups using volume profile, market structure, and box ranges, while also touching on risk management essentials and how significant macro events influence his approach. Let's get started. Today's podcast is sponsored by TradeStation. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures products, including intraday rates as low as 10% on select U.S. index futures and low rates on popular energy futures products like heating oil and gas. Open an account today and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Visit tradestation.com/Anthony to learn more. Pharm, welcome back to the show, my brother.
Hey, thanks for having me, Deli. It's good to be back. It's been about a year, I guess, right?
Yeah, it's been about a year, and boy, has a lot changed, whether it's markets that have changed. I mean, so many things. The landscape of this world has changed so much just in the past year. And, I've been following you now for a couple years, and you continue to grow on me. I love your stuff. I love to see how much your Substack has grown. I know you're doing a ton of great work there. You see it through people on X always talking about the stuff that you do, and you're killing it. And so I'm super happy for you. And today I want to talk about one of the things that I believe it's a really important topic, especially as futures traders, right, Pharm? A lot of people come from the stock side and they're almost only trading long. So they just always looking for places to buy. But when you're on the future side and you're trading the indexes and you're in a bull market, you still have people trading both sides. So I want to focus on shorting a bull market.
Yeah. And the dangers of that, right? I mean, it's definitely something that's important to talk about. There's times to be short, and there's times to be long, and sometimes there's times to sit on your hands, I suppose, right? But I definitely play the short side pretty effectively. Not everybody does, and it's not for everybody. So that's why I say sometimes best to just be sitting on your hands and waiting for the right time to be long if you're not comfortable with that. But as index traders, it is pretty important for us to be able to go both ways.
Yeah. And, look at even myself, who's the best year of my career was in 2008, and it was a down year. And obviously I made a lot of money shorting that year, but that was a really unique time. I mean, I was around during the dot-com bubble in the late 90s, 9/11, obviously COVID. But I could really look back in time and say, historically, I am not making more money short than I am long. I mean, now maybe like I said, my best year was a short year. Not that I was short the whole time, but it was obvious because of what was happening with the global financial crisis. It's unique, and it's still nothing has been like that since. I mean, what are your thoughts on someone who, I know that you started on the stock side. You're not someone who's like grown up into this industry. We've talked about that. I mean, you made great waves in this business, and you've learned so much about it. Do you even think that shorting's for everyone? It's just what's your overall thoughts on traders coming in and just being short?
Yeah, I mean, it's really not. And the thing that I look at is, you had 2020, 2021, or the back half of 2020 anyways, and it was just a rampant bull market straight up and to the right. And traders got used to just buy every dip, and that's great. Then 2022 came, and some of them got washed out if they hadn't really learned to be adaptive and play both sides. Of course, you had new traders that started in 2022, and it was a pretty gross year for most of it. And some of them struggle. 2023 and 2024 because they're stuck wanting to short everything. And so, I mean, the market does go up and to the right pretty much all the time, right? And so, you can talk about shorting it from the perspective of a day trade scalp, but generally looking to swing short the index is going to be pretty far and in between, right? And to me, there's very select criteria that someone needs to be looking at before you decide that you're going to take that dive and just try to short the index. Because I know there's a lot of traders that have come to me that are in the Discord. 2023, and this is after March, right? Where maybe they followed somebody that was really bearish for whatever macro reasons, and said, "Hey, this is the big one," right? And I'm talking about after we broke out from 4,200, right? And I think most of us that have been around for a while looked at that and were like, "I'm not shorting that shit." Like at least until it comes to 4,600, like you just can't short that, right? And a lot of people blew up. I feel like between March and I guess it was July of 2023 when it was just straight up. So, I mean, there's really very select times for it in a swing market. And a lot of times, I manage long accounts that are like long only and I'll hedge them. And a lot of the times I don't even bother hedging, right? Over the course of time, right? Like 2009 to 2022 was just like, okay, I mean, like you hedge a couple of times and, 2018 or whatever. But like a lot of times it's just, you raise a little bit of cash and that's your hedge and you're looking to buy the dip. So it is something that one needs to be really, really selective about. I understand there's a lot of people bearish for various different reasons here. Obviously, we had a nice short recently, but going back to that well a little bit too much can get you in trouble. And I think that's, something is like I play a bear on TV, like we kind of have fun with it. And I do love when stocks go down because I want to buy them and I want to buy them cheap. That's why I didn't make a lot of money on Palantir buying it at 35. I made a lot of money buying it at 6, right? So we have fun with that, but a lot of them have appreciated the service because they stay out of trouble. They're bearish and they want things to go down. And as I joke a lot on X, like if I'm not short and you are, then good luck.
Here's the thing about shorting too. I mean, this is the great thing about futures too, right, farmers? It's the ease of being short. You can be a short as easily as you are a long, and I think that's obviously one of the massive benefits of it because it's just a stop, right? You're just picking a direction.
Yeah.
And I'm not advocating that people really don't get short. I just think that when you are in certain market environments, people get too caught up trying to be short.
Yes.
I think that's the problem. It's not about being short because I mean, who knows? Next week I might be short all week. I don't even know, but the point of the matter is, and you said this from the beginning, criteria, it matters even more when you're going against primary trend. Now, if we're in a sideways market, the market environment's just chopping along where we're not really in this bull market like we have been, where markets are staying within single digit percentages of all-time highs, different time, right? Yeah. But when you're in that single digit percentages near all-time highs, and momentum is on the side of the bulls far more than it is on the bears, people get too anxious and they get too caught up in like trying to find that short. And I think that it takes away from them trying to focus on the overall primary trend. And I know that you and I talk as though we're, longer term, but we're really short term, right? I'm a short term. I trade intraday to swing mostly. And I know you do that as well. So it's not that we are not day trading. It's just a matter of the path of least resistance, right? You feel like shorts get too anxious and too early, maybe even a majority of the time.
Yeah, I mean, that's exactly right. You said it, looking for that short as prices going up and up is definitely the wrong time. And you don't have to be first, and it's generally not going to work out very well. I mean, there are some things that you can look at, at a very tippy top that we'll get to, in a bit with some charts to like, maybe hedge. But I mean, I didn't even directionally short, the top. I hedged at 57.20 ZS, but I didn't short that. And then as I, stopped out on some longs as things started to move down, then, I became a little bit directionally short. But it wasn't until, we made that lower high in the 56.20s that I was pretty loud about. I mean, to me, I wasn't first in. I wasn't like, I didn't short the exact top. And like, I'm okay with that because then I got a fantastic setup, to short a lower high. And so I think it's spot on. It's just people that are looking for it, and they want to catch something when it's going straight up. And that's just not the way to do it because, you're just going to take paper cut after paper cut, or if you're just holding something, against trend, that's how you blow an account, right? Like I'm never holding a swing against a long-term trend. That's one of the big rules that I have for people. And they just get in a lot of trouble seeing it go up and they're frustrated about it and, they're bearish for whatever reason. And, that's just not the time.
Well, let's dissect some of the criteria because I think that's what we're here for today. And I think it's really important. I've got a whole list of things I want to go over. First is, do you really think counter trend trading is for everyone? I'm curious what your thoughts are on that.
It's definitely not. I mean, I think most people should be only trading with primary trend, really, especially if they're newer traders looking to buy dips in an uptrend. I mean, like, You look at the monthly, it's in an uptrend. You look at the weekly and assess if that's in an uptrend. You look at the daily and assess if that's in an uptrend. Buying dips in that situation is just insanely forgiving, right? I mean, if every single day is making a higher high and a higher low, and your execution is kind of crap, and you miss by a couple of handles, like you're probably going to get bailed out of that trade. And so to me, again, for earlier traders, like that's one of the biggest and most important things that you can do is just really focus on being in alignment with those higher time frame participants because it's so forgiving. You have a whole army of bulls out there. The entire market is designed to go up. So, they've got your back, right? So if that's the case, then you get a little bit more forgiving on some of those trades. And, very few people are cut out for, being early with short and trying to be an innovator. That's when you really get into trouble. And so it is really best for most traders, in my opinion, to wait until at least the weekly trend has shifted. And we'll get into, some things to look at on the charts with respect to that.
I mean, you said it best. I think this is the most important thing. There's more forgiveness when you're going with trend in any strategy, right? If the bigger, larger, longer time frame and primary trend is up and you're trying to short into this bull market, you better be more precise because it's going to be less forgiving when you're wrong. And, and then you can get caught up in a whole whirlwind there. Obviously, Pharm, you've been doing this for a while now. What are some of the lessons that you've seen from traders out there trying to be bearish and just misjudging the market momentum?
Yeah, misjudging the momentum. You got to keep in mind that, the market and the market's opinions and its momentums, doesn't necessarily have to align with your bearish thesis, whatever that may be. And when you're constantly seeing, weekly uptrends, weekly higher highs, weekly higher lows, daily higher highs, daily higher lows, and every dip is being aggressively snapped up, then you see like those bearish engulfing days, right? We've had like 4 of those, and then it just immediately snaps back up to a new high. I mean, like that should be a bit of a clue to you, I think, or a hint that like, okay, this market's pretty strong, right? Because I thought bearish engulfing candles were supposed to be, well, bearish, right? And so there's always little clues that you need to be looking at. And you really have to wait and see to where buyers are really offsides and stuck, and there's overhead inventory, and they feel the need to get out, right? Because we can engulf 2 or 3 days in a single bearish engulfing candle. We have done that a few times, and price returns, and you don't see a supply response, which would be, those potentially trapped longs, they just don't sell. There's no response there. We saw that the entire year. And that was actually one of my first clues in July was the Qs, actually. For the first time after one of those nasty bearish engulfing days, it actually responded. Those trapped longs decided, okay, I need to get out. And so that gave me a little bit of a clue in terms of the strength of the trend, that maybe it was maturing a bit. And so there's, to me, subtle clues that you can use to gauge momentum. And again, if you're bearish engulfing 2-3 days and then you just rip right back to a new highs, just hands off on that, trying to short that.
I think one of the things you said that's extremely important when you're looking at a top or when you're looking at counter trend trading, you're looking at shorting a bull market, is you don't need to be first. But that's what happens. It becomes contagious, right, Pharm? I mean, that's the thing. You see what happens with the bears is that every time we're down, I told you so, right? And it's just impossible really to pick those moments clean. And it's why even for myself, like this year, I feel like majority of the time when I've been short, it's really not worked out so well for me, and I've been doing this a long time, and it's just tough because, and even when I think the signs are there for being bearish, they've come back so fast where you're like, okay, well, that was so short lived. And it just kind of comes out of nowhere, right? Even when I try to be a bull and say, well, look at this tape is bearish for now, bang, the next day out of nowhere, it comes back. I think maybe the next thing is let's take a look at the charts.
Yes.
And let's talk about how you spot signs of weakness.
Yeah. So I've got a few charts here, and you can pull. Got the monthly chart of ES up here. And so let's just first zoom out and see this is what you're bearish about, right? I mean, it's pretty much straight up and to the right. But I mean, the first clue to me that you would be looking for is, if you really mean to be bearish, again, this isn't about day trades. I'm not talking about, day trading the index all the time. But if you're generally looking to be bearish price, then you should see, monthly lower lows, right? Monthly candles taking out the low of a prior candle and really twice. That's not going to happen very often in a bull market. And so, you look at the pullback that we had into the end of August, and it was pretty gross. And we've got, a monthly lower low, monthly lower low, monthly lower low into the bottom, right? And that's the thing about bull markets, is that they can just snap back on you real fast and reverse that trend. Obviously, you had 2022, but look at 2021. You get a bearish engulfing month. You're like, oh my gosh, here we go. That was the top, and then boom, right? So you just finally took out the lows of a prior month. And that's it. And you just look left, and it's very simple. You can see these bull trends here. We took out the prior low of August in September of 2020, but then the next month doesn't do it again, right? And that's it. All you did is you just formed a consolidation on the monthly and rip higher. And so it's the same thing here in 2024. April was a nasty month. A lot of people got really bearish, and it was nasty, and it was a great short. But the next month stayed inside and then just ripped right back up. So to really stay bearish price, you're going to have to see, the monthly or at least the weekly, and I'll flip over the weekly real quick here. Same thing. You're going to need to see a weekly lower low. And again, really twice, because, just taking out 1 week's low doesn't necessarily put a lot of traders above you trapped. And so I'm generally looking for, as like a first criteria, like I'm not even really looking for shorts unless there's some other compelling reason, but big swing shorts until we've taken out a prior week's low, like absolute bare minimum. And I do look at volume profile as well. So we'll touch on that chart in a minute. But that's something that's key for me, is taking out a prior week's low before you're looking to get meaningfully short. And one of the other things that I'm looking at, and I'll flip over to my volume profile chart here. And like a lot of traders aren't familiar with volume profile, and you really don't need to be intimidated, and you don't need to be a volume profile trader to like keep an eye on it. But in general, if you're back in here and weekly is just grinding higher and value is grinding higher and higher, it's probably not a very good time to be short. And value here, I've extended the value ranges on, these are weekly profiles. I've extended those just so you can see them. If the value area low, for example, in this week is entirely above the value area high from the prior week, like it's kind of hard to be bearish there, right? And we essentially did a lot of that, or overlapping higher, all the way up. Now, what you look at then is, is there an ability for sellers to establish value lower on a weekly basis? And, this top wasn't clean on like a weekly profile, but the weekly profile is not the holy grail, right? But you can still see off the top, there was this volume put in here, high volume, then low volume, then more high volume. So they're building volume lower and lower and lower and driving those prices down. So that's, to me, the first thing that you're looking for. But like as you're just trading up higher and higher, it's going to be tough sledding, because these buyers are not trapped. You need for them to feel a need to get out. It's a bull market. There's passive flows that a lot of times will chew through supply. And there's a lot of times that supply just isn't even really there because buyers don't feel the need to get out. So to really press on some kind of a meaningful swing short, you're going to need to see buyers in trouble. And if I could switch back real quick just to this other chart here, I'm going to go to the 30 and show kind of the other thing that I'm looking for outside of, and yes, I have a 69-minute chart. You just saw that on there. But I found something interesting on that chart. So I'm just going to zoom in real good here. And, you can see that we formed this range of consolidation. And so, like I said, pressing a swing short, I want to see a weekly low taken out. To really start looking for day trade shorts, I kind of need to see a prior daily low taken out at least, and then form some kind of range of consolidation, right? Because if you're just straight up, like you're just, good luck, right? So we formed this nice consolidation range, call it a box, call it a balance range, whatever you like. We had taken out a prior day low here. This was like Thursday, the 11th, had taken out Wednesday's low, I believe it was. This is all hours, but if you look at regular trading hours, the cash hours, it did. And so you can see the struggle that buyers were having every time they got up above 5,700 ES, right? So they'd come up here and then they'd liquidate, and they'd come up here and they'd liquidate, and they'd come up here. And so we had boxed this range. I called it 5630 to 5708, basically these highs. And then coming into that next week, sensing that maybe there's a little bit of fatigue here and buyers keep liquidating off these highs. Maybe you're looking at like NAIM and CTA positioning, and so like maybe everything's looking max long. You can look at those kinds of things. But once you start to get these failures above this consolidation range, that's another clue that I will look at to potentially get short. But and certainly the second one, and you can see what happened after the second time they failed. But to me, this was the short here, and that was the one that I was pretty loud about on X, right? So we had done the technical damage first, and then we just come back up here and we back test, and we've got all these longs up here that are just completely bagged. And that's when it's time to start looking for a meaningful swing short. So I did not swing this short. I swung this short. And so did I miss out on some money? Well, not really, because I had hedged. And like I said, as I stop out of swing longs, then my hedge becomes a directional short. But if you just try to short this, you can see it was kind of tough sledding, shorting this, like, okay, maybe you caught it. But this was very, very clean, this move down here. So those are some of the things that I would
stay here for a second. I want to talk about a couple of things with you I think are extremely important. One is, how important is it for you to box out a range like this before you even look at any strategy signals? So you talked about monthly, we talked about weekly, and then you went and you boxed out ranges saying, look at, okay, here's what I'm saying. And take us just through that mindset to this point.
So to me, those are the two separate ways that you're going to get a trend change, because by taking out, a weekly high and a weekly low is effectively its own box if you want, right? And then if you take out a prior week's low for the first time, you can kind of box those 2 weeks. It's a different kind of box than just drawing out price action, but it still effectively is a box, right? So there's two different ways to change a trend. And to me, it's the establishment of value lower and lower on higher timeframes, or it is breaking a box to the downside. But you will not have a shift in trend until you break a consolidation range the other direction. And so it's really as simple as that. So if you want to try to be the sniper and you want to try to take the look above and fail here, then you enter somewhere in here, your stop's right here, you get run, right? But if you take this one as the second one, as a look above and fail, and you enter once you come back and fire back in here, your stop is here. But your target's really just the bottom, right? Because you haven't broken that box to the downside. And you can see it gets kind of tough to hold before it finally broke and then still comes back up. There's a lot of sweat involved in trying to snipe the top. But like, you can be precise and you can narrow your risk on something like this, right? So if you happen to take this second one, you didn't take this first one and get stopped. If you take this second one, then your risk is pretty small. I mean, what was it, 20 handles? And I said 5708 was the top of that range. So like, you're risking 13 handles on a swing. That's absolutely nothing, right? If you're looking to get, 100. And so to me, that's how you would top hunt and top snipe, is you either get a weekly low taken out, and then you come back up to the top of, those 2 weekly ranges, and you can look around there. Or if you're good at drawing boxes, you would see a box forming once you have at least taken out a daily low. You can see it form, or you can start to predict where it is going to form. And then if you want to fish around at the top, at least now you have tight risk and when you're wrong, right? Because if this had broken out and just kept going, you're done. Like, you're not short, and you lost 13 handles, or like $1.30 on SPY, right? If you're trading SPY puts, that's not terrible. If you're looking to get a $10 move to the downside, just this range was 7. So that's not horrible. So like, I always say, like, if you must, try to, put a halt to this trend and you want to try to be an innovator, finding some kind of range of consolidation, taking a look above and fail is at least the way to do it, to me, with the least amount of account damage. But if you're just like swinging randomly short anywhere in here, this could break either way. You have no idea. And so this is the high reward, the high R, right? It's the high reward to risk, but lower probability. Anywhere in here is terrible to me. But I mean, this is at least, maybe it's a lower probability given high time frames being bullish. relative to this probability. This is a more highly probable trade. But then obviously your R is a little bit better if you nailed that entry, right? And didn't get decayed out too much on like holding puts or whatever. So, to me, those are the two ways, are just waiting for that lower high. That's ideally back testing your box or some kind of key volume profile element or technical element, depending on the style of trader that you are. But the higher reward to risk and frankly lower probability is finding one of these ranges and taking the look above and fail, covering most at the bottom, and then now it's a short once you break that to the downside. But you cannot change trend from bull to bear, and in my opinion, without taking out weekly lows, obviously, or forming some kind of a consolidation range that then breaks to the downside.
Yeah, some key criteria that I took away from this. One is you're trading the edges. So when you have your box, when you're trading on the edges and you're not trying to sell the top of the box, you're waiting for the high to form, as you said, then it comes off. You have a tight stop for a good risk versus reward. So at that point, you're putting at least the R in your favor, right? If I'm wrong, I'm out. But if I'm right, I can capitalize pretty well
Right.
on this.
That's
Right.
right.
And the next thing is it really just clarifies that you don't want to be in the middle and you're not stepping in random areas, as you said, and over trading the tape, which I think is where most people make the mistake. And the other thing that you mentioned, which I think is also a good alternative that people really should look at more, is options on futures. Because if you're going to trade ES or if you're going to trade, MNQ, there's options on micros, there's options on ES. If you get up in that area, you can buy a few days out, or there's 0 DTEs every day in futures as well. It's a much better risk versus reward versus death by 1,000 cuts trying to short the futures
Right.
if you don't even want that 13 handle stop that you mentioned. So I think
Mhm.
those are good criteria because it's good risk management and it's creating patience. You're staying on the edges. You're not really forcing it. Those are really, really good examples for him.
Yeah, and you bring up a good point with the futures. And actually, I'm not 100% sure this is correct. You may know this, is it's not an issue for me. I almost accidentally committed like a flex or something. But I'm told that trading the index options do not count on pattern day trade accounts. So
Yeah,
I don't know.
options on futures. Yeah, they don't. There's no pattern day trader for options on
Yeah,
futures.
right. So
So I mean,
I
you
mean,
could go in and buy an E-mini S&P option.
yeah,
Probably if you're going to get a week out and it's a little bit, let's say it's a little bit out of the money, you're looking at, I mean, anywhere. It's hard to say what they be priced at, but $4 to $10. So you're looking at, whatever the price of the future is. So for an E-mini S&P, if it's $10, let's just say it is, and you
yeah,
buy one, it's $500 a risk. I mean, that's
right,
locked in, which I think Pharm, honestly, for a lot of people for counter trend trading, they're better off buying that trade versus trying to position manage and
yeah,
trying to figure out, oh, that stop is 13 handles. Because we know Pharm, what are they going to do? They're either going to sell more when it gets up there
yeah,
or they're going to get ticked out, then sell
yeah,
it again. Sometimes when you buy
yeah.
the option, I'm so glad you mentioned it. You're kind of like, it's over. But if it works, you're going to get paid.
Yeah, no, I think that's right. And one of the other things that I will do, and I don't know, maybe it's a little bit too complicated, but for me, it works. I mean, you're in a bull market, so you probably have longs on the way up, right, in your account. So to me, this is the perfect time to take some profits on longs. And if you want to add, that ES put or whatever it is, right, or maybe it's SPX or SPY,
Yep.
whatever. Now you're not just directionally shorting the market up here, but you've taken profits on your longs and you're sort of narrowing your book out just a little bit on that side and thinning it out. And you add that short. And like I said, for me, it started off, I hedged actually this move at the top because it was frankly bullshit. But I don't know if I can say that on the show, but it was just a bullshit move into the end of the day. This just random pop up on no volume. The profile was a perfect balance day, if I remember correctly. And it was just oh, here we go. We're going to go higher now. And I was like, just stop it. So,
Those
but I was
damn
still
market
wasn't going
makers
to, yeah,
fishing the highs.
I still wasn't directionally shorting it at that point. I might have overnight, but yeah, I mean, it was just stupid. So okay, add the hedge. And then I did have some longs in here. And so then I just stop out on some of my longs and now I'm directionally short and I caught the top, right? So yeah, I mean there's ways, if you're running a blended book to, if you were long on let's say you were long micros here, on the way up and you're taking some profits, and then like you add some, puts or something like that, then you're sort of, neutral here, right? So then if it rips higher and you stop out for your 13 handles or whatever on your puts, which isn't like that damaging necessarily, right? And you're still long the micros, a couple of runners or something like that, you're okay. And so I do like to tailor just a little bit. Again, maybe it's a little bit too much for some people. They like to be like purely directional, or not. But when you get these big balance ranges, like think of how well you would have done if you just like long, add longs at the bottom, cover some shorts, keep some runners. It just gives you like an extra 5 handles of wiggle room, right? So you're constantly not having your stop run. If you kind of have just a little taste on both sides of the tape. So I will do that a lot, whether it's micros as a swing short against a runner on an ES long, or whether it's puts against, a long runner or whatever. And so, especially if you're trying to fight the trend, like I kind of would rather have some longs in my account so I don't feel like a complete idiot, when it just rips higher on me and I take that 13 handle stop or whatever. Like I don't usually risk that much, but still, like, doesn't feel very good, right? So
I love your mindset coming into it. Like I'm trading primary trend and you're focused on trading primary trend and you're trying to keep core positions. And that actually frees you up to when the market is topping out. You've set this criteria in place where either you, like you said, you're either going to take an outright short or you're going to take a option or you're going to use micros, and then it's going to be adjusting the position sizes. But I think that so many people would benefit so much by just taking that advice of the way that you approach the market. Pharm. I think that's such an important piece of this, because your approach is I'm going to trade with primary trend, but when I'm shorting a bull market, it really is, and all the things we've said, it's got to really check this criteria. Not that the long setups you're doing don't do that as well, but you're really going to be a lot more specific about what has to happen in order for you to play against that bull market trend.
yeah, that's right. And as we've talked about, you and I talked about a year ago, like for me, again, personally, like I'm not looking to always make these large directional calls. I'm mostly just trading what's in front of me. So there are times when it's very obviously time to be long. And there are times, not very often, where it's, very obvious to be short. But a lot of the times we're in kind of one of these ranges, or we're in a tough spot. And so, yeah, to me, like I'm not looking to make, some of these big, bold calls necessarily, but just trade what's in front of me. And so to me, at the edges and at the critical junctures, I would rather either be flat or like kind of hedged or neutral in some kind of a way if I'm going to be initiating there at all. And so I usually like to, initiate at those edges, right? And if I feel like maybe we're getting that directional change and I want to take the other side of that, it just helps so much. Having the long runner, for example, in the case of flipping short, just hurts a lot less because I like money. I like to have more of money, and that's where the market comes in, right? So just always choosing a directional trade. Like last Wednesday, was it right, where we had a nasty 90 handle sell off, right, and then just ripper 150 handles right back up. Like you need to be able to adapt and understand where those edges are, to flip that. And so I know there's a lot of people that were short into that 54.10 to 12 spot. But, fortunately, our group knew that was kind of like the line in the sand, right? We had kind of boxed out that range. It was like the Thursday before or Friday before range. I think it was 55.32 half down to 54.10. And so that's a spot. So like, at least if you're taking profits on your shorts in that example, and then maybe you hedge with a long, because like you're a bearish, you want it to go down, you want it to go to zero, negative infinity. You've made money shorting it from 5,500 down to 54.10. You've taken profits on your short. Then you add a hedge, and now when it starts flying in your face, you're just like, okay, well, shit, my short's dead. But like, at least you have not taken a red trade, And if you choose to hold that, what was initially a hedge long, and cut your short and just flip long, like now all of a sudden you're long, and you caught the bottom because, you hedged at the bottom because you knew that was the edge. So there's just a lot of optionality, at least understanding where the edges are going to be. And then, if not just closing your position because like you're kind of hopeful that maybe we go to negative numbers on ES because, I don't know if you know this, but like they're actually not a real company. There's no revenue. Yes, like I mean, I try to contact investor relations, and like there's just nobody there. So
Nobody answered there? That's surprising.
it was terrible, right? So I mean, sure, it's going to zero, but I mean, at least So if you want to hold out on some runners on that short, from last week, 5,500 down to 4,400 or 5,410, fine. Hedge against it. It doesn't hurt so bad when it flies in your face. You know what I mean? So that's kind of what I like to do at those key spots. Like again, like I don't have to make a big bold directional call. I knew that if we failed, 50, I think we had a spike at like 55.01 quarter to 55.06 on Tuesday or something of last week, and we came up right in pre-market and we swept it, and then we went straight to hell, right? And so I knew that would be a short, and I knew that 54.10 and down really to 53.85 was going to be a big spot. So again, initiate at the edges, avoid the middle, and I feel like you can stay out of a little bit of trouble, especially when you see something like Wednesday happen, because that was wild.
And that's why they make minis, micros, and options,
Yeah.
because if you want to go against a primary trend, you have options, no pun intended, or
Yeah.
you have micros. You could go against it in a more risk management way. A couple of things before I let you go, Pharm, today. I want to talk about A+ setups. We talked about this in our last show with you. Let's take a look at the current markets. What is it when Pharm comes in, goes to your fantastic, I mean, you've got your Discord, you've got everything going on right now. Give us some insight of what we're seeing in there and what an A+ setup in Pharm's world looks like.
Yeah, well, I mean, this happens to be sitting here, this A+ setup, and I'll walk through it actually on both the charts because it'll just give you a little bit of a taste of volume profile. But to me, it's going with the primary trend, which here had flipped to be a little bit bearish, right? You're seeing a reversion back and an attempted back test higher. And then obviously from this perspective, everybody can see the box being back tested. It was roughly 56.30, I think 28 or 29 or something was the high a day that day. And I was actually looking to enter like 56.22 to 27. And so there's confluence of this box, right? So this is at least like if I'm entering in here, I at least expect to see some kind of a response to protect my position. So just from a box perspective and a consolidation range perspective, this is A+. I'm going to switch over to volume profile real quick. Whether or not you know a whole ton about volume profile. Again, we had talked about how we got this aggressive sell-off in this week, right? And so when you're seeing the establishment of volume and then low volume aggressive move creates this low volume area here into more volume, aggressive move down. So you've got trap longs here, these aggressive moves down really render these buyers and these buyers stuck without having an opportunity to exit. And so I was looking actually right around here in this low volume area or low volume node for this back test. So I was just a little bit early, but I knew that 56.30 was kind of like the line in the sand and really kind of getting back up into here, 56.38, which, is actually where we've been struggling with on ESU anyways, these last couple of days, right? It's the same spot. And so to me, that's A+. We've taken out a prior week's low. We're back testing. We've got a key LVN, and we have a whole box sitting right on top of that spot. To me, those are the kinds of things I'm looking for. I've got supply. I've got volume profile. They're both in my favor in this instance. And more importantly, I know pretty quickly where I'm wrong. And for me, my line in the sand that week was 56.38, which would have taken us back all the way kind of almost into this high volume node here where all that supply is sitting. But like if we had gotten above 56.38 and based, it was going to go a lot higher. And so to me, this perfect back test of where all this buying had been occurring right into a low volume node where they had not had a chance to escape during this week after we got continuation sell down. That to me is the kind of setup that I'm looking for in Smash Hard. And that's why, like, again, especially running the service, I don't post a whole lot of things on X, but like that was the morning, which I'm sure you saw, I was just like pounding the table. Like I am shorting this and I will try 3 times if I have to. And I actually did. I actually took 2 stops, but to your point on micros, I actually shorted that with micros. I short a lot more micros if I'm potentially trading a trend and I want to swing, because I like to keep my day trade vehicle open. And so if I'm short, like, let's say, a million micros because, my size is so massive, Anthony, I can just, you know what I mean? Then I can just be long on those days where it's a long, of course, thousands of ES, right? Like we all trade. And I can still have a green day if I'm swinging short, but the market's up, right? Like how many days in 2022 did the market go up? It went up a lot of days, right? And so to me, again, I like to play both sides. I'll use different vehicles. And so that was just a little bit that I added in there, I suppose, about how I trade some of these potentially counter trend. Now, 2022, I was swinging ES short because 2022 was pretty clear bearish trend, right? 2024 is not a bear market and not even a clear monthly downtrend into a correction, at least in 2024 so far. So to me, I'm just doing a little bit lower leverage, gives me a little bit more scalability because I know that at any time, a bid could come in and just rip this thing a lot higher. And so again, I'm just a lot more cautious when trading against higher time frame trends.
Farm market environment, it's so important.
Yeah.
Right. I mean, I think so many day traders get so caught up in their intraday strategy that they forget what's really happening on the big picture, and they forget that it actually supersedes their short-term strategy. Until we learn that lesson as traders, no one wants to believe it. Everyone, I think, is taught really kind of the wrong way in this business, unfortunately, where people think that just find a short-term strategy, find that process, and just trade it. And that's probably why a majority of the people get caught up in this break even or barely make money scenario, because they never understand position sizing, the things you've talked about. That's why there are micros. That's why there are options. If you want to counter trend, a major primary trend, you don't go all in a poker hand or in a hand to where you don't feel that you have the greatest edge. You only do that in the moments where you have more things lined up, and primary trend is always going to supersede short-term signals, period.
Yeah.
And so, I mean, we learned so much today from you, and I hope people go to your blog and to your Substack, to your Twitter to learn more about what it is that you're doing. And we'll get to that at the end. We'll tell everyone where to go. Last thing I want to talk about before we go that we didn't get into this conversation is just macro. You and I are recording here on a Fed week. That is really the talk of the town right now for all traders. How much, if at all, does it play a role in how you approach your futures trading?
Yeah, I love that you asked that because I'm just going to basically pull up this same box chart. So we're over here. We've got all-time high sitting up right here. Like it's cleaner on the SPX right now. We're doing with contract roll, right? So I've got ES1, which on TradingView is not rolled, right? Because they like to do things a little bit different. But the bottom line to me is like, and I put this in my newsletter this week. Like, I mean, I've heard people say that 25 is bearish because the market wants 50. I've heard people say that 25 is bullish, but 50 is bearish because then the Fed is panicked. I've heard all cuts are bullish. I've heard all cuts are bearish. Like
I'm so confused.
Like I don't care. Like to me,
No.
if we come up and we sweep all-time highs and we fail and we start selling off that, then the market didn't like it. That's probably not very good, right? If we rip to new all-time highs and we keep on going, it's pretty obvious, right? Just stay long and probably long for a couple hundred handles, really. And so, the only other situation then is we don't take out all-time highs and we pull back from here. And personally, I think that's a buy the dip situation, given some of the recent like idiosyncratic sell-offs that we've had and kind of strange positioning situations. I think that ultimately gets bought. And I would be looking to buy it if we don't make new all-time highs. But I don't care. Like, I don't care too much what the Fed does. I don't care to guess. I don't care to interpret. Like, I have my macro opinions. I'm not like the macro expert. More of it's, I don't know, kind of like 12 months to 18 months. But I believe that price is going to tell us all that we need to know out of the Fed. And it's not like you have to position ahead of the Fed or there's never going to be a trade ever again, right? I mean, there's going to be a trade and it's probably going to be obvious come like Thursday, right? I mean, we're all going to get yanked around on Wednesday and lose a whole bunch of money trying to short the pops and buy the dips or what have you while he's talking, and it's going to be nuts. And then I feel like after as Thursday comes in, you really kind of get an idea for what that positioning is doing the next day. So to me, it really is just as simple as that, like a sweep of the highs in reverse and I'm mostly talking about SPX, is probably not that great of a look. And I'll probably short that. And if we break out above all time highs and we keep going, I will not be short anytime soon.
It's such a clear mindset going into it, and it really, I think, will help you execute better. I hope people take notes and understand that. And the funny thing is, too, Farm, if I told you or someone told me the Fed's going to cut 25 or 50, do you think we still know what the market would do? You could tell me exactly what would happen, and I still wouldn't know how to execute it because I still have to watch what the tape does. Because who knows, right? I mean, anything can happen, and you don't know who's going to come to market, when they're going to come to market.
Right.
But I love the way that you talked about just looking at it once again from a boxes perspective and
Mm-hmm.
understand these ranges. Don't get caught in the middle. Watch the edges, watch the reactions. The knee jerk above and back in, or is it above and does it build on it? I think that's, it's a philosophy to where even if it doesn't work out perfectly, you still might make money. You still have a clear
Right.
head of execution.
That's right. That's right. As long as you've got a way to execute, you know where you're wrong quickly. Very simple. So
That's all that matters.
you're right. I don't have to make a wild call.
Farm, this was so great. I mean, glad to have you back after a year. I continue, like I said, to grow as a fan of yours. And I just think you just do an absolutely fantastic job helping traders grow and build and develop. And you're really one of the good guys out there. I hope more and more people go and follow you on X, follow you with your Substack, everything it is that you're doing. And like I said, you're one of the good guys, my brother. I appreciate you so much. Tell everybody where they could go to go and check out that Substack and follow you on X.
Yeah, so on X, I'm at PharmD. Pharm is PHARMD _KS. It's on the screen. And I think probably the best place to go is I've got a website where I'm centralizing things, just farmdcapital.com. There's a free blog section on there that has some introductions to volume profile if you're not familiar. I tried to make it funny. I've got, how I can be sometimes. So I tried to make it pretty ridiculous at times to be a little bit entertaining. And I think you'll enjoy it. It's like 1 minute read for each section. There's like 5 sections. And I'm going to be building that out over time. And it does have links, to the newsletters that I have as well, and some of the other things that I do. But I do encourage everybody to at least just read the free blog section. I will build that out more over time. But currently there's 5 sections and then a few videos that I had on my YouTube at one point that I figured to pull over. One was on identifying trend days early. And, but I mean, really I tried to be kind of funny with the volume profile, market profile type stuff. And it's a very quick read. So I encourage everybody, even if you are not a volume profile trader and don't want to be, it's at least amusing, I tend to think.
Oh yeah, I mean your Twitter's great, and I know when you're getting pumped up, and I'm thinking to myself, boy, he's getting pumped up. He's pumping the gas up right now, folks.
Yep.
He's ready to go.
Yeah, absolutely. I appreciate that. So, and it was really good being on with you again. So,
all right, until next time, my brother.
Yeah, you take care, Deli.